The International Financial Reporting Standard 10 requires a parent to present consolidated financial statements in which the accounts of the parent and subsidiary or subsidiaries are combined and presented as a single entity. Now, before the parent company does that, the structure, okay, the group structure has to be determined. Now, there are three ways in which that can go. Number one, you can have horizontal group structure. Number two, vertical group structure. And number three, mixed group structure. Let's start with the horizontal group structure. Now, this is where a parent company has only a direct interest or control in other companies. For example, let's say company A has acquired 80%, 40%, and 50% in companies X, Y, and Z, respectively. Here's how that structure will look like. In Z Limited, the relationship between the two is that of a joint venture, making the two equal. In Y Limited, A Limited has 40%, which makes Y Limited an associate. And what A Limited has in this case is significant influence, which is defined as the power to participate but not to control. That is according to International Accounting Standards 28. Now you may ask, what then is the advantage of having significant influence? Well, there are a number of advantages to having that, and such will include, you could get a representation on the board of directors or equivalent in the investee company. Number two, you get to participate in the policy making process. Number three, there is the material transaction between the investor and the investee. Number four, there is interchange of management personnel, which means you could benefit from their staff just as much as they could benefit from yours. The last one could be something like provision of technical information. In X Limited, A Limited controls 80% with the remaining 20% as non-controlling interest, usually what is owned by the minority. Now the 80% makes X a subsidiary, and as such, A Limited will consolidate items of X's Limited in financial statements.